Welcome to Seed Sprint, the need for metrics. So I'm going to introduce you. I'm going to talk for a few minutes, and then I'm going to hand over to my colleague Adam to deep dive into the actual metrics. But I'm going to start with the founder journey, because I've been on this a few times, and I've learned over the years that actually a focus on metrics early on is super important. So your founder journey typically goes like this. You're going for a run, you have an idea, and then this idea starts, eating away at you, and you go, I have to do a startup, and you start to build it. And you have in your mind that the building it is everything. But actually the building it is all a precursor to really selling it, having people use it. And that's really where the metrics come in. But the problem is, when you start, in your mind, the challenge is about getting people on board to follow your vision. It's about it might be, just sell more cheese, but it might be change the way people do their banking, or, oceans or something. And you're on this mission. And switching to this mindset of KPIs, OKRs, CAC, LTV, and other buzzwords sounds sort of venal. It sounds like you're taking your eye off the mission. And so you can easily, as a founder, find yourself fixated that you always just want to build stuff. But building stuff isn't going to help you. In fact, it could be said that all the time building stuff is a failure to be able to sell things without needing to build it. So let's go through firstly the journey. So you have this idea, then you start putting a team together, you create a PowerPoint, you need investment, you're talking about this amazing future, you're talking about how you're going to get more users, how you're going to get more revenue, but you have no idea how to actually do it. It's all unvalidated. And then you finally ship a product, and then a modest number of people come along. And now you're stuck in the next problem, which is, I've got a few users. What do I need to do next to get more users? Or will they miraculously come? And Adam will get to that in a few minutes. But before you even get there, you need to have solved another problem, which is you need investment. And in order to get investment, you need to persuade investors to invest in your company. And you've probably done some Googling of, show me a fantastic slide deck. And you'll see these wonderful slide deck things, the sites that go, here's what Uber used, here's what WeWork used to raise 12 billion. These are all completely useless, because when companies are raising that amount of money, investors just look at one page. It's the page that shows revenue growth. And all the other pages could have pictures of bananas. It wouldn't matter. There's just that one metric. So here's your problem. How do you get to create metrics that will excite investors well before that? And the journey you're on goes something like this. What investors really want is a month-on-month graph of revenue growth that's showing your revenue tripling each year, to £1 million or more. So it's all about revenue. So now the problem is, if you don't have revenue yet, because you haven't launched, what do you do next? And then if you don't have revenue, you might show revenue projections. But investors know that's just a projection. So what can you do even earlier than that? So maybe you'll show user numbers. You're not selling anything yet, but I'm measuring the number of people using my products, and that's going up month on month. But you're thinking to yourself, thanks, Anthony, that's great advice, but we don't even have users yet. We haven't built it. What's next? So if you don't have users, going back one level further, maybe it's user engagement. You haven't got thousands of users, but the small number of users, you've got metrics showing how many minutes a month that they're using it, how many minutes a day, how often they're coming back. So it's all about user engagement. And if you're showing lots of engagement, investors will buy in to get to the next step of the dream. But what if you don't even have user engagement? Well, maybe you've got a B2B product and you've got signed partnerships. So you can show investors, I've got these partnerships signed. But maybe they're not yet signed. Maybe that's a work in progress. So then you're going to show investors, I have got partnership proposals. But of course, investors are a bit savvy, so they know the difference between a signed proposal and a signed agreement and just a proposal. But if you're not even there yet, maybe you can show that you've got validation of your prototypes, that you've done user testing and users love it, that they want it. And investors can see, okay, great, at least you've validated the idea. If you don't even have that, because you're not there yet, well, maybe you're going to show your wonderful team that you're creating. And if you're not even there yet, then, well, basically all you can do is show a PowerPoint and wave your hands and promise the future. So what we're all about of this series is to help you go from the arm waving, give me some money, to a more metrics-driven approach, because investors will only give you small amounts of money because it's a super risky bet based on the arm waving. That's your friends and family or £150,000 SEIS round. If you want to raise much more beyond that, it's all about the metrics. So one of the things to note, by the way, is that investors, of course, know when there are what are often called vanity metrics, sometimes called BS metrics. So, you know, what companies sometimes will do, and I'll see in a slide deck, is there'll be web page hits or site views, or investors will see lots of company partnership logos. And when they ask you about it or contact the company, they're not signed deals at all. They're not even proposals that they've received. You've spoken to somebody at the company who might vaguely remember you. So be super careful to not have metrics that, or not show things that investors will not perceive as valuable. So now the next thing is, what kind of metrics are investors looking for? And actually, you've got two real problems to solve. You've got, number one, the actual metrics to grow your business, where we'll hand over to Adam in a few minutes. And there'll also be the metrics that will impress your investors, because you'll often need their money well before you can build. So when you talk to investors, one of the things you want to know upfront is some of the terminology that investors are going to talk about. So you don't want to be a bit too full of yourself and having these words trip off your tongue all the time, because firstly, not all investors know about it. And investors might know that you've picked up buzzwords and you're throwing them around. But broadly, the things that investors will be looking for and the terms that you might want to think about learning and applying are CAC, customer acquisition cost. How much does it cost you to acquire a new customer? If you're building a social network, you might have to spend, you think you'll build it and they'll come, but you may need to do lots of buying of ads. You may have to give money to Mr. Zuckerberg on Facebook to buy traffic to come to your app. And if you're not monetizing it, your customer acquisition cost is going to give you more traffic, but unless you're raising lots of money, it's going to kill you. The other word you'll need to know is LTV, lifetime value. So if the lifetime value is how much will a customer spend with you over a period? And broadly, you're ready for Series A funding, which is investors giving you millions of pounds, when you have a product that is in the market, that's used by people, where you have a big market addressable segment, and your CAC, your cost of acquiring a new customer, is less than the LTV, the lifetime value of a customer. So a lot of what your journey is going to be, firstly, getting your team in a mindset to focus on that. Two, getting enough investment to get your product live and get users and something for sale to the point that you can measure it. Then actually measuring it. And once you can show investors that essentially their money will go not on a speculative bet that you'll build something, but rather that you've shown them that you've built something, and by giving you more money, you can prime the pump, you can buy more advertising, because the cost of acquiring a customer is less than the amount that you'll make from that person. And that is when you're Series A ready. So you might be thinking, this all sounds a bit meh, you know. And for me, it was a bit of a journey for me, because in previous startups, you know, the BBC is a startup, but my mission was to bring iPlayer to people. There was no revenue on that. And then my other startups, some of them were social networks, and you need to grow it huge before there's any revenue. So in my mind, I've often been thinking about, you know, growth at all costs. And it really took SeedLegals, my business partner, my team, to remind me that actually what you need to do is really early on switch gears from just build it and keep building it and keep spending more money into sell it. And it sounds a bit like, and some of your early team members might be disillusioned. You're losing your mission. It's not about sales. It's about changing the world. But you really need to get over it. And the reason you need to get over it is because if you want your business to have a profound influence, if you are on a mission and you want to disrupt lawyers or clean the oceans or move to a vegan world or simply sell more cheese, the only way you're going to do that is to have a scaled big operation. And the only way you're going to do that is if ultimately, and fairly soon, hopefully, it's profitable. Otherwise, you'll be forever raising money, and investors, when they look at your acquisition and lifetime value, will not be inclined to invest because they'll see it's just hemorrhaging more money. So with that in mind, I'm now going to hand over to Adam. And just before I do, there's one thing to note, which is you might be, as a founder, the doctor with dialysis, mother on a mission to change that. And so you know all about your domain. Or you might be a technical person that's great at building stuff, but you might not be the metrics person. It may not just turn you on. You may not be the Excel guru. You may not want to spend your day or even know about this stuff. So what you need to do is find a co-founder or build a team of colleagues that focus on exactly that. And that is my intro to the.
I think you're muted, Anthony, but that can be my cue if you're done. Yeah. So hi everyone. Thanks all for joining, and yeah, looking forward to talking to you about this. So yeah, I think Anthony was saying this, but yeah, if Anthony is the arm waver, then and the person who sells the dream to the investors, then I think maybe I'm the person who tries to make that into reality. So just to give you a bit of insight into me and I guess my role at SeedLegals, my background. So spent a number of years at Funding Circle. So I was there from about 10 employees to around 1,000. Built sales teams in the UK and the US. Subsequently worked for other startups in, I guess, sales, commercial, operational roles, and joined SeedLegals a couple of years ago, where I'm responsible for the customer-facing part of the business here, so marketing, BD, sales, and customer support. I guess what I'm going to focus on, and Anthony kind of touched on this, is investors are absolutely focused on financial metrics, demonstrating traction, and I think what you really need to show is growth rate, a strong LTV to CAC ratio, or at least a route to that strong LTV to CAC ratio, and we can talk at the end about that calculation. And also, yeah, if not profitability today, then at least a route to that. So that's what investors are interested about. And so what I want to talk about is then how do you actually translate that to your team? Because to Anthony's point on mission, it's quite hard, or if I'm in a tech role, or if I'm in a product role, or in, I guess, a non-revenue driving role, it can be quite difficult to get excited about CAC, and maybe more so about LTV. So then how do you, what I want to talk about is how do you translate those metrics that investors want to see into something that can help you run the business day to day, ensure you know that you're on track, and hopefully motivate your team to drive towards the metrics that investors want to see. So let me share my screen and we can dive in. Can I get a thumbs up, maybe from Anthony, if you can see it? Okay, perfect. So talking about startup metrics. So firstly, yeah, I want to start with a story from my past to kind of maybe show you, hopefully it resonates, or may resonate with some of you. So talked about working at Funding Circle, and so our business was about providing loans to small businesses. And I remember a point very clearly where we've been growing, this is very early on, we've grown at a decent rate, and much in the way that Anthony had spoken about. It was kind of like, yeah, build stuff, speak to some customers, try various things, and our growth was still going well, but we had this number in our mind that we wanted to get to. It may actually have been a milestone to raise the next round, and we wanted to get to a certain lending figure a month, so I think probably a couple of £1 million. And someone came in to look at the business and spoke to me and spoke to the founders and kind of said, well, how are you going to get there? And again, I hope this may resonate. No one really had a good answer. We wanted to get to a couple of million a month, but the answers probably ranged from, oh, we'll get some more customers, or we'll hire more people, or we'll work a bit harder, or yeah, we're just going to keep on going. And that there wasn't really a clear plan to get to that £2 million a month. And for context, a few years later, we were lending hundreds of millions of pounds a month. But there are steps in order to get there. And I guess I hope here what we can do is accelerate that journey. And as I said, this may or may not resonate with people today, that there's a milestone you want to get to, or there will be a milestone that you want to get to. And I think then the real question is, how do you actually get there? So I want to start with some common mistakes. Sorry to start on a downer, but again, some of these things may resonate. So I think one of the most common and kind of resonates with or links to the story I was talking about there is only tracking outputs or lagging indicators. So what's an example here? An obvious one is revenue. If it is maybe more about customers, the obvious one there would be the number of customers that you have. If I take revenue, revenue is a lagging indicator. It's a function of all the work that's gone before it, driving, I guess, creating the product, driving people to the site. If it is a sales-based business, driving through a sales team, et cetera, et cetera, et cetera. And so with these lagging indicators, this is really a measure, kind of a measure of what you have done. And if you only focus on these, it's too late when something goes wrong. So when you see your lagging indicators drop, if you're looking at the right leading indicators, you're going to spot that sooner. So the problem here, if you only track revenue, it's great when everything's going well, but as soon as things start to slow down, you're not going to know what levers to pull in order to address it. And actually, to look at that more positively, when things are going really well, you want to understand, well, why are they going well? And you can pull that lever and double down on the things that work. Another one I see, which is probably the other end of that spectrum, is just too many KPIs. So Anthony threw some acronyms around before, one of which is KPIs. So KPIs, I'm going to kind of use as a synonym for metrics, so key performance indicators. When I see businesses with too many KPIs, then I just go back to what does that mean? It's key performance indicators, it's not performance indicators. So if you've got 100 KPIs, you've got way too many. And to illustrate that, I'm sad to say this is actually, it's not used anymore, but this is an internal document. I've removed the headings, I've removed the rows, but how can anyone look at this and know what's going on? I am fortunate or unfortunate, depending on how you look at it, and that I studied maths, so I can absorb it and I can probably pick it out. But for most people, and even for me, there's not much here that tells me how things are going. And I think it can be tempting sometimes to think, okay, we want to measure everything, and then dump it in a spreadsheet like this, and then no one knows what they're actually supposed to focus on. So we have the extremes of only tracking the output and trying to track everything. Probably kind of within that too is not tracking the right things. Again, I'll kind of give a sales example here. I remember working somewhere and someone kind of proudly showed me, oh, look, this is how many calls people make, or this is the average number of contacts per customer. Okay, brilliant. What's the conversion rate? And they didn't have it. They couldn't track that. What's the average revenue per salesperson is probably more relevant. And so there can also be this temptation. I think again, it comes from not defining up front what you need to track, of either tracking everything or not tracking things at the right level. And that example I gave you, sure, it's nice to know how many times we're speaking to each person, but more fundamental to the business is how many of our customers do we convert. So we need to start with the key things and then dive into the more granular things in time. And then the final one, and one maybe more relevant at a slightly later stage, but I'll share the example too. So in terms of inconsistent usage and interpretation, if I start with interpretation, as in a previous business we scaled internationally, we had inconsistent definitions of the same thing. And so if you'd be looking at something in one country and it had the same name as something in another country, but the actual definition was completely different. So then again, probably not a challenge today, but the reason why this is important is you really need to define them clearly, because again, as you grow, which I'm sure lots of these businesses will, you need to make sure that you are defining things in the same way so you can compare and contrast. I guess perhaps a better example and more relevant is what you will also see sometimes is inconsistent usage of definitions by team or by level. So perhaps customer support refer to the same, track something differently to someone in sales, or sales and marketing, that they're not aligned on the definition. You're kind of setting yourself up to fail. And actually, I guess I'll give a SeedLegals example and to illustrate inconsistent usage. And so Anthony mentioned his co-founder, Laurent, who is an investor, is a very analytical guy. And he had this master spreadsheet, which had way more rows than the ones I showed you, way more detailed and not quite as pretty. And he had this rich data and this rich source of information that he was looking at, but nobody or very few people in the organization were actually looking at this. And I remember having a conversation with him saying, well, if these are the key things that you want to drive or that we need to drive as a business, then if we can make these visible to everyone else, then guess what? They're going to start driving them too. And if with everyone focused on those key metrics, then they're going to move. So yeah, I think these are some of the common things that I see. Only tracking the output, like the example, my personal example I shared, trying to track everything or thinking that you need to track everything, not tracking the right things, and that's more about level of detail and granularity. And then, yeah, inconsistent usage across different levels. So maybe the co-founders or founders look at it one way, the team look at it differently, or between teams. Marketing call a lead one thing, sales call it another, and you just do not have alignment. So yeah, really important is, I think, investing some time in getting this right up front. And so I'll talk a little bit more about that now. So in terms of choosing your metrics and KPIs, so Anthony gave some examples earlier, like if you're a B2B subscription business versus a consumer app, your metrics are not going to be the same. So there are going to be parallels in B2B SaaS businesses if you compare one versus another, but there's still going to be differences and nuances. And so I think this is definitely sector dependent, even if you're consumer versus B2B, but also business dependent. And the real key question, I think, is what are the key drivers of your business? I'm going to show an illustration of SeedLegals to maybe bring that to life slightly, but yeah, what are the key drivers of your business? And notice I say drivers, not output. So revenue is the result. What are the key things that drive there? It could be app downloads. It could be, again, the example of an app, it could be daily usage. It could be weekly usage. It is, yeah, you can get a guide based on the sector that you're in, but it is going to be business specific. So I think taking the time to really understand what are the key drivers of the business that are going to drive to success, and then measuring and then, yeah, focusing on improving those metrics. Talked about this a lot already, but yeah, consider the leading indicators. So yeah, revenue is output. You want to know, if you take a funnel, what are the key steps that I need to happen before then, which are going to tell me if I'm going to get to that revenue number or if I'm going to get to that number of customers, users. Because then, again, if things are going well, double down on that, keep on doing more of what you're doing. Things are going less well, you can course correct ahead of time and not have any nasty surprises in 3 months. And then I showed the hundreds of KPIs on the other one. I would really encourage people to focus on, yeah, 4 to 5 key metrics or key KPIs for your business. And I'm going to kind of illustrate that with some like dummy data around SeedLegals. So firstly, I'm not sure how familiar you guys are with our business, but we have both a subscription part of our business and also a pay per use part of our business, so like a one-off business. And so it's slightly nuanced. I've combined the metrics slightly just to illustrate the point, and hopefully this will kind of bring it to life slightly. So if I were to, at its core, talk about SeedLegals as a business, and firstly, yeah, these numbers are dummy data except for the customer satisfaction, because I wanted to show you all how happy our customers are. But if I wanted to look at SeedLegals business today, and look, we're approaching 100 people, so we'll probably not be exactly the same as a business at seed stage. I think I can get a really good snapshot of our business by looking at these 5 things. So free trial started, how many people are getting started on SeedLegals, because that is kind of the top of our funnel. How many total subscribers do we have today? How many are currently subscribed? What is the revenue? And then 2 satisfaction metrics. So 1, customer satisfaction. Are our customers happy? And 2, and this is something we do measure, what is our employee satisfaction? So are our employees happy? And so that gives us a pretty holistic view of the business in terms of how many new users can we expect? How many total customers do we have? What's the revenue that's being generated from them? Are our customers happy? And are our employees happy? And then to highlight it further, if I take the most recent week, I have a really quick snapshot of what's going on here. So you might see at the top, free trials are going really well. People in this example, more and more people are starting using the product. But in the last week, no more customers have subscribed. We haven't added any subscribers, and so don't know why, but need to dig into that. Revenue has dropped off a cliff, so also need to understand why. And then also employee satisfaction is halved. So who knows? Maybe in my example, the sales team are overwhelmed because there's so many people starting free trials that they're just all demotivated and they've stopped doing any work. So we haven't added any new customers. Who knows that the numbers are made up, but hopefully this gives you an idea in terms of, I can get a good sense of the business here, including how people are feeling by really thinking about what are the key things I want to measure within the business. Okay, and I think final point here, and it kind of goes to the point I mentioned about when I first joined the company. So if we define those overall KPIs, what is then really important is ensuring that each team's KPIs, so if I take customer support as in my example, are feeding those overall ones. So clearly customer support are very closely aligned to our customer satisfaction metric, and that is the case today. They will then have probably more granular metrics below that, which are going to also tell that team if the satisfaction is likely to continue. So something we track, for example, is first response time. So we don't want to keep customers waiting for too long. And when we see our first response time creeping up, i.e. getting slower, that tells us a couple of things. Either maybe the capacity is not right, so we need to accelerate our hiring, or maybe that is an indicator that people are not going to be happy, or maybe we need to invest more in self-serve. Any number of things, but again, it's just the example of that leading versus lagging indicator. Satisfaction is giving me a good view of how we're doing, but our response time is kind of giving me a bit of an insight into what's that metric, and actually then our churn going to look like in 2-3 weeks down the line if it stays at this rate. So yeah, really important that the team KPIs are linked to the overall ones. Again, I'll share an example with our business where our focus on subscriptions has increased. Historically, certain teams were not really focused on there, and so we then had to take a look at our KPIs and say, well, look, if we want to seriously grow our subscription business, we have to measure those things, create that visibility within teams, I guess specifically marketing and sales. And if we do that, they're going to be working to drive those metrics, and we're going to achieve it. If not, we're kind of hoping. We're hoping that the product is good enough to do it. And to Anthony's point earlier, part of the picture is building a great product. Equally important, in my view, is marketing in the right way and ensuring that you kind of take customers through that funnel. Also wanted to talk a bit about embedding this and creating this kind of KPI or metric driven culture. Anthony talked about it, and I do think that, to be honest, the earlier you do this, the easier it is. It is vital not just for investors, but yeah, I mean, also for the success of your business, and really just knowing that you're on track. So I guess my message is that the earlier that this is done, the better, and the easier that is. There's some points in here around team, and so I know some people may not be at that stage, but still, I think it's worth thinking about and considering and building that muscle. One, to get investors on board, but also in anticipation of starting to scale that business. So yeah, in terms of how to do that. So again, I think lots of people here are founders, so this is maybe a call out to you. The example needs to be top down, and Anthony talked about maybe he's not naturally someone who's really into the analytics and the data side of things, but what I think he's done well is co-founded a business with someone who is, and then brought in people who are strong in this area, and then enabled them to do that, and allowed the culture to move in that way, and the results, I guess, have followed that. So I guess I'm saying you don't have to be the data-driven person necessarily, but I think recognizing and encouraging the value of them is absolutely the role of the founder. If it's not your core skill set, there are ways around that in terms of hiring someone who's strong, having a co-founder who's good in that area, but the example definitely has to come to the top, from the top, for it to stick, like with everything really. Really crucially is just building these key metrics once you've defined them into your weekly or monthly and even daily cadence. So what do I mean by that? So we have a weekly all hands meeting, and I think lots of companies do the same. And so ensuring that KPIs and metrics are visible there really kind of demonstrates it's valuable to the company. Discussing this at the leadership team level, and I guess obviously at the board level is also important. And then taking that into one-to-ones with employees, monthly reviews with employees, and just building it into the norm, making it business as usual. That is a really crucial part to make sure that it sticks. And we were actually, well, this might be a distant memory being in offices, but we were kind of discussing internally the other day. There are a number of things you can do here in terms of screens in the office. That's why I say it's maybe a bit of a moot point at the moment with lots of people working from home, but how can you recreate that in a remote environment? So you can send things via Slack. If you're using a CRM, you can automate that. You can send things via email. But I think even if you're not at the stage where you're investing in something like Tableau, and I wouldn't actually encourage doing that at the stage you guys are at, even if you are tracking things in a spreadsheet or in Google Docs, then circulating that relevant info at the right period, maybe it's not daily, but at least weekly, is going to then just encourage people to consume that information. It's going to then make them aware of those numbers and start thinking about how they can do it. And again, it just reinforces that culture of these are the key things we need to focus on as a business. Here's how we're doing against them. And people then have the information and can act on them. Linked to that point, I think is all about making them easily accessible and visible. People like myself are going to want to go and find them, but I recognize that not everyone is naturally motivated or interested by really digging into the numbers. So what we need to do is make it as easy as possible for them to see it, help them to understand it if needed. But really, I think recognizing that not everyone is going to go and hunt for these numbers, and you need to make it as simple as possible for them to find them, or better still, send them to them, is really, really key. And then another thing is, and look, this goes for lots of things, I would say, not just KPIs, is recognizing and praising positive behaviors. So again, I'll share a SeedLegals example. So someone in our customer support team who deals with funding rounds, she did some analysis as to why certain rounds would maybe not go the route we wanted, or we would have to make custom changes to things, which led to things slowing down. So she did this phenomenal piece of analysis, and there were great findings. We found that we could reduce most of those, and that's all amazing. The conversation I had with the person who led that team was, yes, recognize the quality of the analysis, but what I think is really vital there is actually recognizing that behavior and say, look, actually, what I really want to praise here is vitally, what's the thing I want everyone to take away here is the fact that this person has thought to go and do this analysis. This is the type of thing we want to see. So I don't want to praise her intelligence. I want to praise her mindset and the approach that she's taken. And I want to see more people doing that this way. And as I said at the start, that doesn't, I don't think, just go to KPIs. That goes to lots of things. But recognizing and praising those behaviors not just the actual work, is something I would consider really encourage. So kind of touched on this throughout in terms of making sure people can see it. I think in terms of other considerations, something I would encourage everyone to think about is how important is transparency and what information do you want to share? So I've been lucky enough to work for very transparent businesses. I would include SeedLegals within that. And what do I mean from that? What do I mean by that from a KPI or metrics perspective? Lots of business will communicate revenue, but again, particularly at an early stage, what is it a pertinent information? It is things like burn rate, it is things like runway, and I'd really encourage people to share that level of detail and be transparent around that, because then the team, again, it brings it to life, and the team kind of then see the importance of this and why we're really focused on these metrics. So shouldn't be used as something to scare people or to put fear in people, but I think that transparency is really valuable and a really key part of getting people to buy into it. As I said, I've been fortunate enough to work for very transparent businesses, and so yeah, everyone at SeedLegals knows how we're doing from a revenue standpoint. There's also very good insight into profitability, understanding of cash we've got in the bank, and look, when that's good, obviously that's easy. The difficult bit comes when it's less good, but even so, I think it's a really important cultural point which KPIs can really support. And I think thinking about that level of visibility you want to give is something I would encourage thinking about. Different people, I think, will have different views on it, different tolerance to how transparent they want to be. I would encourage you to be more transparent rather than less, because it really helps with buy-in for the team. Anthony talked at the start, and hopefully there haven't been too many acronyms throughout, but we'll just talk a little bit about KPIs and OKRs. So KPIs, as I said, are key performance indicators. I gave an example of what they could be for SeedLegals at a high level. They'll be different for your business. And those are the things you want to kind of track on an ongoing basis, and hopefully they're going in the right direction, and you want to monitor, and people are focusing all the time. OKRs, another acronym, stands for objectives and key results. And this is something else that we will use, well, we do use. So on a quarterly basis, as a business, we'll set what are the key objectives that we want to focus on, what are the key things where we really see an opportunity to improve. And that could be, I'm trying to remember Anthony's examples at the start. That could be sell loads of cheese to take that business. The key results are then the ways that you measure if you're on track. So the objective is an aspirational statement, it's qualitative. You then have key results, which are quantitative, to tell you if you're achieving that goal. How the two can work together. So KPIs, as I say, are those things that you're kind of monitoring the whole time. OKRs are where you pick something you think is really high impact, and you then want to kind of align the team around that, and really double down on trying to achieve that goal, or move those metrics. You could even take one of your KPIs, or one of the things within the funnel, decide you want to align the team around that for a quarter, or at an early stage business, maybe a month. Really get everyone focused around that, track the results, and it's a good way to really drive focus, to hopefully step change that metric or that part of your business, and can be powerful used in conjunction with your KPIs. This is probably a conversation, or like a whole presentation itself, so I'm not going to spend long on it, but my observation is that every single business I've worked at or been involved in has like properly invested in data infrastructure too late, or put another way, wishes they'd invested more in data infrastructure earlier. Look, I don't suggest your first hire should be a data engineer. I don't suggest before you've raised your pre-seed, the first thing you want to do is get your data infrastructure right, because obviously you need to demonstrate traction. You have to get things off the ground. However, I think it's worth thinking about as you start to build this traction and as you have, I guess, more confidence that the business is going to succeed, really investing in that data infrastructure early saves a lot of pain later on and gives you the platform to really kind of accelerate it to later stage. So yeah, probably not a consideration right after you come off this call, but it's something I see again and again, where the later you leave it to sort out your data infrastructure, the more difficult it is. To summarize, I've had lots of points, so I want to try and distill it into a couple of takeaways. So number one, and I think we're going to focus on this more in the other sessions, like what are the key drivers of your business? That is not revenue, that is not the number of customers if it's an app. It's what are the key things that really drive your business? Really spending some time thinking about that and making sure you can track them, making sure you can then focus on them, making sure you can then work out how you pull the levers to make them go faster. Keep it simple. As I said, I think some people's tendency will be to track everything. That will come in time. I remember we hired a customer analytics team and it took our data to another level, but we had hundreds of people in the business. It's trying to measure everything right at the start, I think, is dangerous and just means that you risk not focusing on the things that are really crucial. So yeah, really taking that time, keep it to 4 or 5 key ones that are really impactful, and they can change over time. But yeah, really taking it down to the handful of key KPIs is vital. Yeah, making them visible and accessible, but just you. And then as your team grows, just making sure everyone is, if people are focused and are looking at these things, they can then, it's in their minds, they're going to be thinking about improving them. And then, look, as with anything, I think ensuring people understand the why, or put another way, like how it fits into the bigger picture. So again, if I'm in a functional role, why does this KPI that you're asking me to work on, how does that fit into the wider company vision? Like, why is it important that I need to respond to customers quickly? Done badly, people just feel like they're being forced to do something and they're being micromanaged. Done well, if people understand that a key responding quickly is more likely to keep customers happy, is more likely for us to retain them, which is a key KPI for the business, that is a much more motivating and engaging thing than just make sure you respond to people as quickly as possible. And again, I think the why goes to the transparency around the business. Like, why are we focused on these metrics? And why have we chosen these metrics? We believe that these metrics are the ones that are crucial to business. We're looking to raise our round in X point in time, and we need to get to this level. Done well, they can be a very powerful motivator. And the crucial thing, I think, is tying the team metrics to the company metrics. And I think having everyone understanding why are we focusing on these metrics and what does it mean for the company, what does it mean for us. So I think.
All right, Adam, thank you so much. And actually, I think, Adam, you've got our team OKR meeting in a few minutes anyway. So, so I think, you can see from Adam's presentation that if you're an investor investing in Adam's company, you'd be quite confident that they knew what they were doing. They were totally focused on that. And that is what excites me with Seed Sprint, which is over the next few weeks, how can you, get your thinking and your team's thinking, everything around that. Now, it turns out my business partner is an analytics genius, and it's fundraising with Laurent is very easy because investors go, so, have you thought about cohort analysis? Which type of companies might buy some products? And Laurent would go, well, let me take you to page 33 of my slide deck. Well, I'll do a cohort. How would you like the cohort analysis? Would you like it by segment, or would you like it by revenue size? And as soon as the investor sees that, they go, I don't know what these guys do, but they seem to know what they're talking about. And that is what you'd like to do. The other thing is to make sure, as Adam does with our team, that the entire team is thinking about these things. Because really the challenge you have as a founder, and I've been there, is you take money from investors, you bring in team members on a journey with you, you launch, and things don't pop. You know, you've read about Clubhouse going to millions of users, but actually that's incredibly rare. You have to work seriously hard to get people to use your products. And where it gets really stressful is you just don't know, as Adam said, which levers to pull. The numbers are sort of, they're going up a bit. Should you spend more on Facebook advertising? Should you add another feature to your product? How can you get your team to do all of this? So with that in mind, just before I hand back to the Spice team, let me answer very quickly a few of the questions in a few minutes or less. So number one, for the CAC to LTV ratio, do other costs come in as well? Which dovetails nicely with the next question, which is, with investors, do you differentiate between angels and VCs and so on? They both have a very long answer, but the short answer, I think, to both of them is that for investors, it's all about your company showing a believability. And initially, there is a believability gap. You're arm waving, you've got a PowerPoint, but there's nothing to validate it at all. So all the things you're doing are looking to validate to an investor why they should invest in you. And the initial validation is, it doesn't matter how much it costs me, can I get somebody to want to use my product at all? Maybe the product's got no use. So in the first part, it doesn't really matter if you're spending more on acquiring people than monetizing. In fact, you may not have any monetization. And that's just fine if you can show you spend money acquiring a customer and they stick in using a product and telling their friends. That's great. But you can't grow the business sustainably like that. So later stage investors are going to see that it's great to spend money acquiring customers. That's what all businesses do. Banks spend money acquiring customers, but they have some way to monetize it afterwards. And so your message will change in the early stages from, yeah, it doesn't really matter that all these other costs we're not showing on the table, PR, marketing, the cost of our servers, the cost of the team, we haven't split it out. It doesn't matter, just we pay Facebook less than we make from this user. We'll sort the rest out, will come out in the wash. But later on, they're going to want to know more. So yeah.
Guys, just to add one point on CAC. So again, it's probably a topic for a whole session, but it's there's some debate and some people do it different ways, but it's a high level. It is the cost of acquiring a customer, which is definitely all marketing headcount and costs, like spend on Facebook, spend on Google Ads, plus the team. And then there's an argument that, again, if there is a sales team, they're involved in acquiring, you should also include the sales headcount and tools within that too. So yeah, definitely marketing spend, definitely marketing team, marketing tools, and then for the complete view, including the sales headcount and sales costs in there too, is another way to do it.
Okay, and thank you, Adam. And then also what you're going to do is you're going to slice and dice it to find the most effective channel. It might cost you X amount on Facebook, but less on LinkedIn, or it's better to invest in PR and so on. Next question, which is, how does this all work if you're trying to get a loan rather than equity investment? So that's a great question. So once upon a time, you'd go to the bank and you'd borrow money. The problem with that is the bank will only lend you money if you're making revenue and you can repay the revenue, and there's a high chance that your business will still be in business later. And if you're a cheese shop, that's great. You sell cheese, you borrow some money from the bank to buy more cheese, you sell cheese at a profit and you pay the bank back. The problem is the bank only charges a few percent revenue if it's 8%, interest. If it's only 8%, it means they need a 90-something% chance of getting their money back. But if you're an early stage startup with no revenue yet, you're way riskier than that. So banks just won't lend you money. And the other thing is you can only borrow money if you can repay it. So if you still have work to do to build your product and then to grow the user base, and you can't repay a loan, not only will the bank know that and not lend to you, but you just won't be able to repay them. So that's what equity investment is for. It's for investors. In the UK, the vast majority will get their SEIS and EIS tax deductions to de-risk it for them. And they'll say, I will give you money. There's a 50% chance your business will fail, but I'm hoping that with a 50% chance, you'll make a 4x or a 10x return for me. and therefore the whole process is worth it. So fundamentally different between, loans and equity based on the type of business. So I think those were the other questions. A couple of people have already emailed me. Let me just see if there's one more question. Right, so there's one question, of course, about finding investors. That's a subject for something else entirely. I won't go into finding investors here, but for now, and for the seed sprint, we're going to talk about impressing investors. Firstly, that you know what you're talking about. Secondly, that your team is totally focused every week, even every day, on looking at the things, the leading indicators, not the lagging indicators, to help create that culture as you move from let's stop building stuff to let's get focused on why people want it and help get it out there. Thank you, everyone. And now back to Purdy and MA.
Thank you. Fantastic. Thank you so much. I think this is one of the first events we've done where we have had only one person drop off. So bravo to the both of you. And now we are going to cover one more important question, which is how can you sign up for Seed Sprint and why should you sign up for Seed Sprint? So I guess two questions. So to start off, well, for those of you who have already signed up, you will have received the onboarding pack. So you probably read a little bit about what I'm about to cover. But for those of you who haven't, Seed Sprint is divided into 4 focus weeks, kicking off this Monday at 9:45 a.m. Each week is really designed to help you nail a different component of your business that investors care about and cover the metrics and help you identify the metrics that are most relevant to your startup given your stage in the categories of product market fit, customer acquisition channels, the validity of your revenue strategy, and finally, we'll be putting that all together to help you develop your investor outreach strategy. So for the first, actually for all 4 weeks, the week is divided into 2 sessions. First is a workshop, again, Monday, 9:45 a.m. You'll probably hear me say that a few more times before we end. But you'll have an hour workshop with an angel investor, very active angel investor, who most of the angel investors are also ex-founders too. They really know their stuff and they are so ready to help you decide which metrics will help you gauge how you're doing in those categories. And then after Monday, you'll have a week to focus, dial in on those metrics, develop a strategy for how you can grow. And then we're going to come back on Friday. And as you probably saw in the chat session or the chat channel during the talk, is that we have a room full of really smart founders. And we have over 230 founders already signed up for Seed Sprint. Really diverse background. Some have already built and sold 6 companies. Some have a lot of industry experience and now they're first-time entrepreneurs. So you have a really rich group and a lot of experience. And so you can tap into the collective knowledge of your fellow sprinters and get your questions answered. You'll have the hour to ask for feedback, share roadblocks that you're experiencing and ask questions, and hopefully probably someone will have a good answer for you. And then on top of that, we also have a WhatsApp group. So during the week, as you hit roadblocks or find an interesting article that you thought was relevant, you can pop that in the chat and talk to people.
One of the big things that we're doing as part of the sprint is getting weekly updates from you. So this is the big focus. This is the accountability side of things. If any of you are familiar with Y Combinator, week-on-week growth is a massive indicator of early success, especially at pre-seed and seed. And we've spoken to a lot of investors about week-on-week growth metrics, which is exactly why we're doing this. So every Friday, we're going to ask you to update where you got to throughout your week. So you spend the whole week generating and demonstrating growth, and then you'll input your metrics at the end. This means that at the end of 4 to 6 weeks, you will have 6 weeks of growth data that you can then take to your investor and say, this is why I'm great. This is me going out and demonstrating what I've been doing. This is why you should trust me.
So, I was saying we want to get your pen version.
This is why I'm great. We obviously understand that sometimes you're not going to have the most amazing week. You're not going to be growing 100% week on week.
Your co-founder's sick.
Your co-founder's sick. You've tried something and it didn't work out. there will be an option to add qualitative data as well as the numbers to all of your metrics. So you can write all of this stuff and you've got reasons, and you can go to investors and say, this is what I did, this is why I did it, this is what I learned. And it will just give you an extra in when you're talking to investors at the end. So that's going to be happening every single week as well.
Then, so after those 4 focus weeks, you're going to have 2 weeks to go off on your own in August and really put your head down, put your learnings into actions, and then come back on August 18th for your final metric update. After you submit your final metric update, you're going to have 2 opportunities to meet investors. We have our Angel Founders Speed Dating event. We've done this several times. It's been tremendously successful. And 15 founders will be selected to meet with 15 angel investors for one-to-one meetings. And then we also have our final demo day as well. Both of those events will be in September. And so the way you get selected for that is by consistently submitting updates and showing that you've made progress. Again, if you have a blip in a week here or there, that's totally okay. This program is really for you at the stage that you're at. So these events at the end are fantastic if you have the opportunity to be a part of it. But even if you don't, you'll still leave with a great investor outreach strategy and a portfolio work that you can show to investors. So if you have, we just covered a lot of information. And if you're already signed up, you'll have all of this in the onboarding pack already. But if you're interested and want to know a little bit more, reach out to Purdy and I. The email's hello@spicestartups.com or our names at spicestartups.com. So that's Purdy or Margaret Ann. You can message us on Twitter, LinkedIn, anywhere that you find us. Feel free to drop us a message. Again, it kicks off Monday, 9:45 a.m. And we hope to see you there. The registration, you don't have to apply. It's just about a 5-minute form. And then we'll also send you, if you have a co-founder or a team that you want to join for the sprint, that's fantastic. Only one person needs to complete the registration form. And then we'll send you an additional form to just input your team members' information as well.
There's a few questions that are coming in that I can see. I haven't seen all of them. One person asked, who are the angels that are going to be speaking? All of that information is on our website. Yeah. So if you go to spicestartups.com/seed sprint, you can see the speakers on there. In terms of B2B SaaS businesses, you can demonstrate growth because you can talk about users, conversations that you've had, feedback, NPS, all of that kind of stuff. So when we are looking at what metrics you're going to be focusing on that week, we'll be talking about B2B and B2C SaaS. And someone else asked, I think, whether there's going to be any more segmentation happening. We're talking about splitting the group as well, so that you're with a group of relevant businesses talking about relevant metrics as much as we can, given the amount of people that are going through. Okay. Also, a few questions about recording. This session has been recorded. So if you had a team member who you want to show this fabulous talk to, you will get the YouTube link tomorrow in your emails. And then for Seed Sprint as well, if you have to miss 1 week, that's fine. Everything will be recorded and distributed to everyone who signed up. Oh, and one last note that is incredibly exciting. Can't believe I forgot it. SeedLegals has given the very, very generous offer to all sprinters of a £100 credit to use on any of their fundraising services. Information is in the onboarding pack, so everyone sent to sign up.
I totally forgot to mention that. So yes, £100 off. I don't know how this will affect Adam's KPIs, but let's see. So
killed the average revenue per customer.
It's killed the CAC this week. All right.
I don't know.
Thanks everyone for joining. Yeah, any questions, do let us know. We look forward to seeing lots of you on Monday.
Yeah, look forward to it.
All right, thank you. And there are some amazing presenters running each week's session, including the guys from Stripe and Forward Partners and so on. So, you know, if you can use that info to get your mindset and your team's mindset ready, then that is amazing. All right, thank you so much, everyone.
Thank you.